Joining me now is Russell Hackmann, president of Hackmann Wealth Partners. Russell, welcome to the New York Stock Exchange.
Thank you, Ashley. Good morning. How are you?
I'm doing great. How are you?
Fantastic.
So a lot going on in the news and the markets. What do you make of the past 24 hours?
Well, you've had news about the 100% tariffs on imported chips, but also relief for any of those companies that are going to be investing in the United States. So what you're seeing this morning is kind of a relief rally in a lot of the technology stocks, especially the semiconductor stocks, seeing that most of those semiconductors are likely to be exempt from taxation. You've also had some good news on the Apple front as far as Apple saying that they'll be investing in the United States more. That's going to give them favorable treatment for what they need to do, which is continue to import iPhones. And so generally positive news for the market over the last 24 hours.
You mentioned the 100% tariff on those chips. How do you think investors are pricing in these developments and also the tariffs that took place after midnight last night?
Well, I think that in general, the story about tariffs evolving since April has been, obviously there was a big scare back then, but the sense is that the Trump administration and the various countries are working in general to get tariffs at sort of a 10-15% level, with a lot of items actually exempt from tariffs, right? So the concerns of potentially 30% tariffs, 40% tariffs, which of course Switzerland is just dealing with and might impact your purchase of an expensive watch. Other than that, it seems like the tariff news has been pretty okay.
Apple also said they're going to be spending $100 billion in the U.S. What do you think investors will make of this?
Well, it looks like that's good news for Apple. It seems like they are kind of repeating some of the information that they were already investing in the United States, but that's what the president wants to see. Apple really can't realistically build iPhones in the United States anytime too soon, so they want to be seen as investing in manufacturing in other items in the United States, get tariff exemptions for all the iPhones that we buy, and the market is sort of cheering that on, saying, okay, Apple, you're not going to get, hit with very expensive tariffs on iPhones. You're making commitments to U.S. manufacturing, and that's going to get you favorable tariff treatment.
What's your take on the extra amount in the tariffs being passed on to the consumers?
Interestingly, if you look at sort of the mix of economic data, you really haven't seen spikes in inflation, right? If there was, and obviously it may be too soon to see that yet, but if we were seeing, oh my goodness, like inflation's coming in, some of the numbers were coming in over 3%, that would be very concerning to the market. But at this point in time, you're not seeing really elevated inflation numbers, and that's part of the story that is leading towards the Fed likely to cut in September.
Let's switch to earnings. We're at the heart of earnings seasons. What are your takeaways so far?
If you look at the statistics so far on earnings, and it's pretty remarkable, again, against the backdrop of April, when after the first tariff announcement, you had a big downturn in business sentiment, you had a big downturn in consumer sentiment, and those two things led to a lot of concern. And what you're seeing with the earnings season is a stat that I saw is 82% of the S&P 500 that announced beat earnings, and that's the highest number in 10 years. So versus being very concerned 3-4 months ago to, wow, that was a really good quarter. There's certain companies that are really excelling, AI, et cetera. But good news on the earnings front.
You mentioned the Fed interest rates have remained unchanged. What do you think is going to happen in September?
It does seem like there's an emerging consensus, especially after some of the job creation data was amended over the last few days, that the Fed, and you've seen various voting Fed members and other Fed members, Kashkari was the most recent one, saying, hey, we're probably going to be cut. They are all but saying we're we want to cut in September. Now, there's been some dissent within the Fed, but the markets are saying there are most likely a couple cuts coming this year.
And how do you think that will affect investors if interest rates are cut?
When you have this kind of, there's always room for curveballs, but when you have this kind of Goldilocks scenario where inflation is under control, second quarter GDP was good, earnings are good, but the job market's a little weaker, that's a little bit of a Goldilocks scenario for the stock market in the sense of, okay, the Fed will cut rates. That's almost always supportive of the stock market, right? So, things are looking good so far as market-friendly data, let's say.
Given everything that's going on, what are you advising your clients on right now?
We work with a lot of people that are close to and are in retirement, but almost for anyone, if you do look at the last 5 years, the S&P is up 100%. So if you're in retirement, close to retirement, you've had a lot of gains in whatever you've had in stocks. So, part of our message is, while things look supportive, it's always smart to take some chips off the table when, you're up big, right? And maybe look at things that are a little more principal protected. We like those ideas because at some point, it has been a long, long time also since we've had a big market downturn. And I'm not saying it's happening anytime soon, but it'll happen eventually.
Russell Hackmann, thank you so much for joining us at the New York Stock Exchange.
Thank you, Ashley.